Okay, and we are live. Good morning on this wonderful Thursday, January 13th. Welcome, welcome. Thank you for joining us on Coffee Time. For those of you who are returning to the show, thank you so much. Welcome back. We always appreciate having you here, and try to join us on the chat when you can. If there's any questions comes up, please go ahead, put some questions in the chat. If you'd like something that we're saying, give us a thumbs up. I also want to welcome any one of you that has joined us for the first time. And welcome. Also, give us a little thumbs up so we know that you are new here, or a little, victory, any kind of a activity down in the chat, so we know that you are with us here for the first time. We would like our videos and our live sessions to be as interactive as possible. So any interaction below on the comments is really highly appreciated, and it'll be more enjoyable for all of us. Um, just a quick intro. My name is Marie Torossian, CPA. I'm a certified public accountant and a chartered global management accountant, and experienced auditor and a CFO. I'm a CPA advisor and a transformation coach, and I use my proprietary methodology, Valuation MT, to help business owners go from their first million to 10 million and 20 million and plus. I've authored a couple of books. Yeah, I will put in the chat some of the links. One of them being The Complete Guide to Business Growth. That's available on Kindle for purchase. I also have a free ebook available that is called A Business Owner's Guide to Operational Accounting. It's a lot of guides, I know, but that's really what we want to provide you.
Exactly.
We are here to be your
Awesome.
guide. Also, not to forget me, and before I make the introduction to Pedro, because I did forget to say, don't forget to subscribe. Please subscribe so you always know when we are going live. Whichever platform that you are watching us on, whether it's Facebook, LinkedIn, or YouTube, go ahead and subscribe to our channel, so you will always know whenever we're going live. Also, quick note before I forget, next week we are going live on Tuesday, January 18. Usually we consistently go on Thursdays at 10 a.m. We had a minor scheduling conflict, so we are switching to Tuesday only next week, January 18th. With that, as always, it's my pleasure to have my featured guest every Thursday, my tax colleague, Pedro Gonzalez, CPA. Pedro, welcome to the show.
Good morning, and yeah, it's great to be here. We have a lot of good information coming up,
Mm-hmm.
uh, and as far as myself, as you know, Pedro Gonzalez, CPA, business and tax strategist. We have issued another guide that is for the real estate investors tax guide. We're working on the S corp tax. That's going to be an ebook that we're going to publish. And it's going to be different than some of the other stuff that you see that kind of repeats a lot of the information about the formation, which is great information. But what we're trying to do is provide some information that will be more geared towards how to maximize deductions, and which is really what the people want when you're forming this type of entities. How can I, take my S corp to the next level?
Yes.
We are working also on our tax planning and tax strategies uh, uh, sessions, and developing a program that will help you and other clients in getting to meeting their goals. Our main focus, as we discussed before, is going to be in the areas of cash flow, improving
Mhm.
your cash flow, lowering your taxes, and developing an exit that will meet your goals.
Yeah, absolutely. And in the past episodes, we've talked about so many issues from, let's say, those who are self-employed, their taxes, due dates. We've also talked about a series on tax planning and what does
Mhm.
that entail. We've talked about partnership agreements, and actually last week we talked about what would be a reasonable compensation for an S corporation shareholder. So these are really interesting information that might take you too long to go out there and research and what do I do with this. And so we are covering these really interesting items within 30 minutes or so. and it gives you really great information and saves you time as well. So if you haven't seen any of those episodes, please make sure to go back and check out some of those episodes. And for today, as we're continuing on some of this conversation about, from tax planning, we moved down to partnerships, agreements, and compensation. We wanted to talk a little bit more about what happens when we purchase a business from
Yeah.
someone. What are some of the tax consequences? Whether we purchase the assets or the equity. So this was something that we've been, talking about, and so we wanted to bring it to you. So Pedro, where would be a good place to start, you would say, for our audience to be able to get into this conversation?
Well, the purchase of a business, the is something that needs to be taken into consideration is the structure of how you're going to buy the business,
Mm,
and may not, some people may not understand it. That's what we want to give you in a short amount of time. A lot of information that you need to keep in mind when you're making that decision. Either you be the buyer or the seller, because what happens is that the basically you can structure a purchase of a business in essence two basic ways. If the target business, let's assume you are the one buying, the target business being an SC or an S corp or a partnership or an LLC that is taxed as a partnership, you have two options. You can either buy the interest, meaning the partnership interest or the shares, or the other option is to buy the entity's assets. Now, if the target business is a sole proprietorship or a single member LLC, then the only option you have is to buy asset. And that's the only
mm,
option you have at that point. So before I go any further, again, I know that we have said this disclaimer before. You're gonna hear a lot of sometimes of us talking about legal terms and financial products and things like that. I am not a legal advisor. I am not a financial advisor. Whatever information we share here, I stand by it, but I do advise that you check it from the legal standpoint, to consult with
absolutely.
an attorney whenever we talk about financial products, to confirm it with your financial advisor, so it applies to your specific situation. Because again, the information we share, while I do stand by it, it is also in general in nature.
Absolutely. And then just if I may also point out that when wealthy people are planning their purchases, or they're planning their
Mhm.
wealth, they don't work with only, let's say, one CPA. Sometimes they're working with multiple CPAs,
Correct.
with a group of attorneys, a group of financial advisors. So always think through with all the different pieces. Everybody's a professional in what they do. So when you bring the right group together, you're going to have the best team helping you out. So here we'll try to cover as much of the general information as it fits in with the work we do, and then of course always go back and make sure with the key people in your team.
Correct. So what happens is, again, we kind of touched up on basically the options you have. What
Yeah.
happens, the challenge is that the buyer and the seller are going to have conflict of interest when it comes to the buying and the selling of a business. If you're the buyer typically is going to want one main objective that they're going to have
Mhm.
is a non-tax objective is going to be to generate sufficient cash flow from the newly acquired business and to service the acquisition, if any, especially any debt involved, provide an acceptable return on the investment. But also, they want to minimize taxes. Oh, and another point that happens when you're buying, and this is again, it's a non-tax issue, but is a concern, and that is minimize exposure to unknown liabilities.
Mhm.
Because of that, typically a buyer is going to want, from a legal standpoint, is going to want to structure this as an asset purchase, because this is the way that they're going to cover themselves from unknown liability, which in some cases it can be a huge risk for a buyer. So
Mhm.
what they're gonna, you know, they're gonna more be inclined towards an asset purchase. In addition to that, there is also a tax advantage for the buyer to do an asset purchase, is because you can step up basis on the asset that you're going to acquire, because now you're going to pay an X sum for potentially assets that were already fully depreciated. So instead of you acquiring those assets at a lower basis, which is
Hmm.
basically what it was already on the books. Because if you're buying the business, you're buying the asset as is, based on what is
Right.
in the books. But if you do an asset purchase, I can then now allocate a higher number and higher value. Now my basis, I stepped up the basis on the asset that I identify in the purchase agreement, and that in turn will then give me a higher depreciation deduction, and it will, in turn lower my taxes, lower my gain when I dispose of those assets,
Hmm.
including inventory and receivables. So that's the buyer side. Now the seller side, uh, their main concern is going to be to insulate himself or herself from um business related liabilities after the sale, in collecting the full amount of the sale price. That typically, they're looking at that, I want to sell it for X. I want to make sure that I can gain or get as close as possible to that number. They're more concerned about getting the full price. And on top of all of that, yes, they want to minimize the taxes. Now, from the seller standpoint, they're going to be pushing for an equity sale or a
Hmm.
yeah. So and the reason is because there is an advantage from the perspective of taxes, and that is I can then it will be subjected to capital gain tax instead of ordinary,
Mm.
and so I can lower my taxes by going to an equity sale. So you can see that there
Got it.
is
Yeah.
that conflict between the two. So then what do? How can you find common ground where if your seller is saying, no, I'm selling the business, equity sale, and you as a buyer, you say, no, but I'm not interested on assuming liability. I want an asset purchase. I want this, this, and this, and this. And so, you have to find, obviously, like any negotiation, try to find that common ground. If you encounter kind of that roadblock, and one is
Hmm.
offer a higher price to complete the asset sale,
Sure.
uh, so you can complete that transaction. You can go ahead and offer a little higher amount to allow you, for example, if you want to complete a transaction, understanding that if you're gonna assume, let's say, for example, if you're gonna go ahead and assume liability, you are the buyer, I'm gonna assume liability that otherwise I
Hmm.
don't want. I can then in that case potentially offer, and the seller acknowledge, you're gonna take from me liability. So there's a way to kind of come up to that common ground,
Balance it out.
and
Yeah.
right, exactly. Take into consideration tax savings that the parties are gonna have. Because if I know I'm gonna be gaining some tax savings, so I might be willing to accept a different price in consideration that yes, I'm gonna be gaining some taxes, but let me close the deal. Let's not kill the deal. You know what I mean?
Right.
So let's close it. But then, this way allows you to complete it. Um, I know it sounds kind of obvious, like duh, but I can tell you when you're at a negotiation table, it's not as simple as it seems. It takes some finesse. It takes some, way to work this out, so then you can complete that transaction. But again, you can see that there is going to be, depending on the advisor on each side, they're going to be obviously, because everybody's advocating for the client, is they're going to be
Absolutely.
presenting is the option that's going to provide the best legal protection, the best tax advantage for each
For their
side.
client. Yeah. Yeah.
And sometimes you're gonna see that there's a conflict, and you
Yes.
have to find that common ground. um, Now, we also mentioned the if it's a sole proprietor or a single member LLC, in that case there's not going to be an option there. There's going to be an
Right.
asset sale. And so because again the tax code ignores the existence of that entity. You know what I mean? They say no, this is sold by an individual, so there's no shares or interest to sell. So
It's more of
uh,
a complete business, purchasing the full business, basically. Good to
well,
know
no,
that.
they're buying the asset. It will be considered an
An
asset
asset.
sale. Asset sale. Yeah. If it is a single member or a sole proprietorship, there's no equity sale in that case.
Even if they have
Uh,
any liabilities and any of that stuff, it still would be considered asset sale.
Correct. Now, when you're doing an asset sale, one of the strategy, again, I'm going to share something here that another value for you is when you're doing an asset sale, what you want to do is allocate more of the price to those assets that generate the higher taxed ordinary income when it's converted to cash. Okay, so what the heck does that mean?
Yeah. Our audience is gonna be like, what?
Exactly. No. Okay. So what does that mean? Which one are going to be those? Are going to be your receivables and inventory. That's where you're going to push more of those dollars, and assets that can be depreciated over a short amount of time, which is going to be your furniture and fixtures, equipment, and vehicles.
Got it. Yeah.
So when we're looking at this and we're advising our client, we're looking at, and let's say we're going to do an asset, then what we try to do is, and again, in the negotiation part and making sure that it goes in, is ideal that it be put on the purchase agreement, not just me as a tax preparer allocating this number arbitrarily. What you want is that as part of the agreement is there, meaning that both parties agree to this. That because if the IRS comes in to challenge this, this is a mutual agreement on how the allocation will be done. But what the goal, if you can accomplish it, what you want to do is allocate as much of the price in an asset sale, as much of the price to the higher taxed ordinary income items. And that's going to be, again, when we're looking at converting, because again, if you're buying asset and that includes inventory and receivables, those receivables and inventory will be converted to cash, and those will be taxed in an ordinary tax rate. So what you want is then allocate,
Yeah. So basically, that's going to convert to income when they sell it, and then that's going to be an ordinary income, taxable.
Yeah, and you want to allocate when you're looking at the depreciable asset, because you want to be able to depreciate those faster. You know what I mean? So you want to convert them to those can be depreciated in the short term. Basically, those that get depreciated, like the furnitures and fixtures, 7 years, your vehicles are 5 years. You want to allocate more dollars to those so you can gain the benefit faster.
Yeah, that's a very very interesting way of handling that. Absolutely.
Yeah, like I said, and when we're doing this session, you can see that we do, share with you information that not a lot of people are going to be throwing this information to you freely. We're doing this as far as education, but also to show you that we have information here that can truly help you.
Yeah.
And while this information right now is in general nature, you can see some of the strategies can help you lower your taxes. Well, you're going to see the benefit. This is what I encourage. I know you mentioned to subscribe, but also to schedule a one-on-one session. I think we can truly, help you if you, contact us on a strategy session, and because there is when you're going to see the value, because now it's going to be targeted to you, to your specific situation. We can take these ideas, which it does work. It's just now we're going to actually bring it to your specific situation and truly maximize it to you.
Yeah, absolutely. And then always as we recommend, make sure you have all your financial records in order, because that's always going to be the key point.
Yes.
We cannot stress this enough.
No,
see over and over where internal financial records don't even match tax filings and tax returns, and that really can cause quite a trouble. And then now you're ready to purchase a business and things don't make sense, or you're the one who's selling your business, and the buyer is questioning every single thing, and you can't even provide documents. And I know I've heard from, even with a client of mine that's been, it has been in the process of purchasing different businesses, and there's a timeline where they want you to review and do their due diligence, and they ask for documents to be provided. And here I am, like, I look at the first documents they give, and like, this is kind of like funny. I have more questions. And it gets to a point where at some point the buyer, in this case my client, would be no longer interested, because he's like, if it's taking this long to produce the documents we need to look at, then I'm uncomfortable as to what else is kind of messed up in there.
Correct.
It's like,
No,
I want to, something you say, Pedro, quite a lot. We've said it in the shows before. We want a turnkey business. We want to go
correct.
in, purchase, and start working and start,
Correct.
making money. So as a seller, if you put yourself in the seller's shoes, that's what they're looking for. And if your business is in chaos, the financial records are in chaos, and you can't produce documents, and it's going to be very difficult for a buyer to have confidence that your business was actually running smoothly and it was running well.
Mhm. Yeah.
Yeah.
Another aspect of this, I know, the intent was to discuss the tax implication of the
Yeah.
purchase, but something that also that comes up going along with what you're saying is cut off financial statements, which a lot of
Mhm.
times the business owners are not prepared for it. You know what I mean? They might have done, for example, right now, they may, if you have a sale, let's say in February of
Mhm.
2022,
Yes.
they're going to ask for not only the December 2021 financials, so you better have them ready, but also they're going to be asking for an interim financial.
Absolutely.
And
Yes.
so that's why a lot of times they get scrambling for this interim, which no, they did not engage their CPAs or their accountants on time,
Mhm.
and that is to have to go back and scramble to get updated financials. So, and as part of the exit strategies and all this that we coach our clients is to all of the other aspects. It's not only about the tax, it's not only about the legal, but also some of the documentation that are going to be required. And like you said, keep hammering this on people's head, and that is
Yes.
the accounting aspect, because there's going to be
Yes.
requirements. If when you're asking for money, when you're selling, there's
Mhm.
going to be or there's a dispute. Then now
Yes.
you have to split your business, merger and acquisitions, you name it. There's many times when you're gonna see a need for accurate information. You know what I mean? So if you're gonna be in a situation you're buying or selling, you're gonna have to have very accurate. And this is why I encourage people that if you're already foreseeing the exit, and this is why we're coaching you, and then we start this. Why you have heard me saying about the 5 year. The reason is that they're gonna be asking at least for 3 years of financials.
True. Yes.
So at least 3 years. So if somebody, and that's any prudent investor is gonna be going, and they're gonna say, give me the last 3 year financials and the last 3 years of tax returns, plus I want interim financials.
Yes.
So that's why we talk about the 5 years, is to have the time, one, to implementation, number two, to have at least 3 solid years of taxes, financial, because we know that you're already envisioning the exit. So that,
Yes.
at least with that 5 year window, so then at least you have 3 solid years that the numbers are tight. I mean, that we know that it ties to your financial, to your bank statements. There's nothing, that could kill the deal for you, because the last thing you want is that the deal got killed, not because of the business, the idea, and you can show other production, but the numbers are unreliable. I cannot trust the numbers because I don't see how it goes from inventory to cost of goods sold, and I don't see it going back. I don't see the flow.
Yeah.
And that's the last thing you want to see. And I've seen it many times, unfortunately, where we cannot conclude the deal because the lack of reliable financial information.
Yeah, yeah. I had a situation where, again, with this gentleman that I've been helping with the valuation process, and the deal that he actually eventually walked away from, the seller was literally scrambling between her accountant. I think she was trying to pull out those, the interim financials, because I had so many questions, and her accountant was just not being available on a timely manner.
Mhm.
And we went back and forth so many times, and then she would call me on the phone and say, can you talk to him, can you do this? But at that point, my client was no longer interested. He pulled away. He's like, it's just not worth my time anymore. And it's a sad situation, because
Mhm.
it's when the seller is ready to sell, but then now, because of you know minor things they could have done to prepare themselves for that exit, like you said, that 5 year plan, but there was no plan. They had a great opportunity, a good buyer, ready to go fast, but you know records were not in order, the accountant was not in line with the timelines, and they just lost an opportunity that could have gone so well for them. So it's always important to plan ahead and be ready. So if you are thinking of doing that, if you're thinking of selling your business in the next, let's say, 3 to 5 years, this is an opportunity to kind of consider where you stand, where you are with your documents, your financial statements, and what you need to do to prepare for something like this. And if you'd like to speak with us, we're always here.
Mhm. Yeah, no, right now it's a good time, Marie.
Yeah.
Right now, because we can get somebody with their 2021 accounting tax preparation and get them 2022 in order, and at
Yes.
least start addressing this possibility. I mean, even if you're in the midst of about to sell my business by mid-year, it's not. It's better than nothing. I mean, I guess what I'm saying is, even if you are in the very end and you're thinking of selling, no, Pedro, I don't have
Mhm.
5 years plan. I have a year or 2 year plan. So right
Sure.
now is a good time, and the reason is because we could get the 2021 accounting all straightened out, get the
Correct.
taxes in order, and at least get the interim 2022 in order. So then
Absolutely.
there's at least some they can see. Okay, I can see even if, let's say, 2020 was a little bit iffy, uh, but I can see the how the corrections were made, and I can see now how this is going to work. I have some reliable numbers now, even though there's a disruption going back to 19 and 20.
Yeah, absolutely.
Yeah.
Any
So
any questions from our audience? I just wanted to check because we would really like to answer any questions and make this as interactive as possible. But we don't want it to be just us talking.
yeah.
Even though we love talking, we love sharing our knowledge.
Yes.
Um, but yeah,
Yeah, and if they want to send a comment or an email later, we're
Mhm.
always available. Like I said, I encourage the people to at least schedule a discovery session, because again, that's where you can also see a lot of value
Yeah,
to tap into something more specific, that either Marie or myself or both of us can help your business.
absolutely. Okay. If there aren't that many questions, so we're very close to our 30-minute mark. So, any last thoughts, Pedro?
No, no. I guess I keep emphasizing kind of the same, but the only reason that I keep repeating that is because of the importance. I mean, make sure you have your records in order. 2022. One thing I wanted to mention quickly is
Yeah.
2021. The taxes. We continue under the same general tax regime. In the past, some of the things that we were evaluating did not happen. We do expect 2022 to be an interesting year. We do foresee some potential changes coming up within some of the tax changes, tax increases that we're expecting to see. So I do encourage people to not, to get too relaxed in the process. Let's get 2021 in order, but
Yeah.
2022, I strongly suggest that you do some assessments. Uh,
Hmm.
because we do expect 2022 to see some tax increases.
Yes.
Uh, and so, just to keep that in mind, I mean, not to forgo. We're evaluating the impact of the inflation. Inflation is going to play a big factor. Also, is another form of taxation. So, how is it going to affect your business? We're evaluating the COVID situation that is also affecting the performance of business. So when you can see that we are not only advising you is in only on tax or in
True.
an accounting manner. That's why I keep emphasizing about being business and tax strategists, is because
Yes.
we're looking at all of these different factors that can affect your business and how we're going to combat that. So then you not only compete, but you dominate. I mean, how are you going to get in front of everybody else? Because that's how you're going to take a step ahead. I mean, to always be a step ahead of the quote unquote competitors.
Absolutely, absolutely. And just a few deadlines in January, I just want to make sure that I remind everyone is the Q4 estimated taxes are due, I believe, on the 18th.
Mhm.
Yep, and also don't forget the W-2s and 1099s are going to be out January
Yes,
31st. So if
yes.
you haven't
Thank
done
you,
it
Marie.
or didn't think about it, just make sure, go back, check your vendor list, make sure who needs to
Yeah.
get 1099, and you have another 2 weeks to get it done. And if you need help, of course, we're always here for you.
Yes.
With that, we are already at our 30-minute mark. We want to be very cognizant of your time. And as busy businessmen and women, we really appreciate you hanging in here, learning from us. And then again, we appreciate your time. And with that, I want to leave you with the note I always say. Who are the 5 people that you are embracing around you, the people that support you, and we hope that the both of us are 2 of the 5 that you're always keeping yourself supported with. We are always here for you, and we'll see you next week. Just a reminder, Tuesday, January 18th instead of Thursday. With that, have a wonderful rest of your week.
Wonderful. Take care.